Trump arguments sound good on paper, but tariffs are taxes. So you said about lowering taxes. Well, when you apply a tax to a transaction international, that's called government intervention in free trade. So they don't like doing that on a domestic basis, but when I buy a product from a guy who made something in China that I like his product and he'd like to get some money for it, that's a transaction between him and me. And for the government to intervene and say, no, we're going to price it at this level, that's outright government intervention. That's a socialist type thing. If that were done domestically, they would renounce it. The Republicans would. But they're doing it on a foreign basis. And there have been some critics of this, within the Republican Party who've noted that intellectually this isn't making trade better. Mussolini wrote about this. He was actually a socialist, by the way. Most people don't realize that. If you read most of Mussolini's writings, it was focused on government doing exactly this type of thing, where government bands together church, the state, unions, business. That's where, the back of your dime, there's this wheat thing with this shaft. Right. Okay, that's the fascist symbol. And that's his notion of don't take over the companies like Marx would have you do. Instead, control them through regulation, price controls, control of their labor force, what products they put out, what they price them at. So, you have a free market? No, it's a form of that. It's merely one aspect of it. If they're charging us too much for a product, then we'll buy less of that product. It affects the pricing level. If I don't mind it and then I pay it versus a product made in another country with a different tariff, maybe a lesser one, then I will determine where I'm going to buy it from, me, the consumer, or a company buying thousands of products from a producing company in China or somewhere else. Superficially, it sounds like, oh, they're free market folks, but no. We've heard this before about, we're going to reduce government and all this. And yeah, it never happens. There's always an excuse. Could very well be, just like the dot-com boom was dead right. They were correct. I mean, the internet was going to change your life. And boy, did it. Again, far more than they thought. But their bubble broke. They overpriced that reality for a while. And it took them 16 years for the NASDAQ 100 to get back up to its 2000 price level, by the way. The Mag 7, NVIDIA just made a new high. Okay, by a few dollars above where it was a year ago. And frankly, if you look at an NVIDIA chart going back about a year and a half or so, you're not really making a lot of money. Most of the gains already occurred well over a year ago. It's been holding its ground, I'll admit that. And Microsoft looks good too when you look at a price chart. But all of a sudden, we've run reports on this, and even just simplistic price reports, chart reports. Normally, we look at momentum. Even the price charts are screaming at you, hey, there's no more Mag 7 anymore, guys. Get a chart of Google, get a chart of Amazon, get a chart of Apple. Are they at their highs? They were in 2024 when the market was making its highs in early 25. Now it's back to its highs, quote, the market, S&P 500, NASDAQ 100. The Dow's not, and so many of these key sectors, particularly consumer-related, consumer discretionary, they're not near their highs. And then we're having, fracturing. I can see it technically in the ETFs of the commercial real estate market that people are just not even talking about. This is where you get ambushed. When these bear markets occur, quite often it's events that come out of nowhere, seemingly, that create headlines. And I don't mean a war over some other part of the world. I'm talking about here. Where suddenly, this company failed? Why? Anyway, yes, AI could very well be exactly what they think, and it will change the world, but that doesn't mean it can't have a bear market. I think you've had your blow off top. I think that occurred in that 23-24 surge that finally took out the 2022 price high. S&P was at 4,800 in early 2022, and then it dropped. And then we came back up, and it took like a year or two to get there. But finally in 23, 24, you blew through that 2022 price high, and you went up, to 6,000. That was, I think, the blow-off surge. Now, this looks like a laborious top. Well, you look at 2007, it was very laborious. In fact, in the last report in December of 2006, we put out a report predicting that the high in the S&P would occur in 2007 between 1550 and 1600. It peaked at 1575 in October, and it took the Fed to do that. I thank them very much for that. Right in our target zone, and yet denying reality all during that time. Like the guys in Big Short banging their heads into the wall. Like, it's true, but it's not working. Okay, but finally it happens. I think we're there. And you can even look at, like I said, price of the market, various other metrics other than the S&P and the NASDAQ 100. They're not making new highs. They were in 2024, but they're not anymore. So the market is decaying despite the CNBC headlines and the Fox Business News headlines about, a new high. Of course, Trump's got to be real happy because I understand he's a tape watcher. So he thinks that whatever he's done right. By the way, you mentioned something a while ago about inflation. let me add this comment. Our analysis of the Bloomberg Commodity Index is that we're about to launch into another bull leg in commodities. And these often occur as assets flow out of the stock market. Look at the late 70s. The stock market was a total wasteland. It went nowhere for 10 years. In fact, we were losing money because it held nominal value, but it didn't really go anywhere. Commodities exploded back then. Global stagflation we had. And yet commodities exploded on the tailwinds of gold. And I think we're about to face another upturn in the commodity markets. I'm speaking technically now. And I think when that occurs, that's going to really surprise a lot of people who voted for Trump, because one of his main issues was, I'm going to keep inflation low, price of gasoline, per gallon is going to be kept low. I think he could be surprised by that. And the public would be shocked, because that's the one main thing they really voted for him for, is to keep inflation low. Falsely measured inflation, by the way. The real way to measure inflation is growth in the money supply. That's been getting more aggressive, especially over the last 9 months, by the way. Nominal price impact of that growth in the money supply, such as in commodities or in the stock market. They don't consider upward pricing of the stock market to be a reflection of inflation. In other words, monetary excess. That's okay. But if the price of corn goes up, that ain't okay. Heck with the corn farmer. But I think that asset class shift, when the stock market gets wobbly as it is, goes somewhere else. It usually goes into gold. You go back 100 years and find big bear markets, gold went up. Why? Because the central bank went to an excess in response to the stock market breakage. Usually T-bonds also go up, meaning yields go down. That isn't working this time. So suddenly you're left with really only one alternative, monetary metals. But I think we're also at a technical point where commodities, which have not been in sync with gold in recent years, are going to get back in sync with gold. And your asset price rise you're going to see is going to be in the monetary metals and commodity category broadly, and stocks related to commodities. If you look at XLE, for example, the broad oil sector ETF, it doesn't really correlate well to the S&P. I mean, there have been plenty of years in the last 10 where the S&P has gone up and the XLE has gone down, okay? Yeah, it's stock market, but it's really not correlated well to it. It's correlated more to oil market, and oil and many commodities are correlated to the Bloomberg Commodity Index. They tend to move with it. Even platinum, which people used to associate with gold, is only now coming to life again. We've defined a breakout a month or two ago. But it's because the Bloomberg Commodity Index, if you look at it, after that rally that peaked weeks after the Ukraine-Russia war began, by the way. So the Russia-Ukraine war didn't drive commodities up. They'd already made their move. They doubled. The Bloomberg had gone from 70 to 140, which is still cheap. Back in 2007, it was 237. So people thought, oh, commodities are off the page. No, they're only halfway back to their old bull high. And then they dropped back down to 100. But for over 2 years now, the Bloomberg's gone dead sideways. Zero decline, zero rally. And it's trying to turn up out of here. We got up to 107 something a few days ago. Of course, that was the oil nonsense. You close a month out above there, you're going to emerge. And I bet you don't even need a headline to do it. It's just an arm wrestling. It's an asset class movement into a cheap category. It's historically very cheap. My personal investments are heavily in silver. Now, we watch gold because it's the mama monetary metal. But silver, people have forgotten. It's been for thousands of years. In fact, in the U.S., it was a monetary metal. I think this time up in the monetary metals is going to be different than the bull markets that we've seen before. Gold went from $30 to 200 back in 1975. Gold went from 103 in 1976 to 850 by 1980. Or it went from 260 in 2000 to 2011. It got up to 1920. But then it had big bear markets at it. 50% drops. Okay. Don't expect that this time. I think we're going to probably end up with a sort of crisis globally, not just US, that causes a rethinking of what money is and realizing that fiat money creates distortions. And therefore, let's go back to something that is objectively stable. Meaning, when gold goes up to wherever it's going, which may be 10,000 or 20,000, I have no idea. It depends on a lot of these other factors in the crisis mode that they put the world in. It's likely to be institutionalized up there. Same with silver. Now, as far as what I think is going to happen right now with silver, we argued a few months ago after we made that spike low in April, which tried to copy the stock market falsely, got to 27.50 after having been $35 in a matter of about a few weeks, much of that occurring in 2.5 trading days. That That was a cleansing drop that anybody who was week long got out. They're gone. Within hours, most, you were back above 30. Now you had dual highs at 35, October of last year and March of this year. We argued that's going to be a triple top breakout in price. But getting back up to the high 34 level told us, one, not only are you going to blow out that high, but we're going to launch an acceleration phase in silver that is likely to see silver trounce gold on a percentage basis. And I think silver likely within the next 2 quarters, or certainly by the end of the year, will see itself in the $60, $70 range. And that's when the vast public will say, gee, what's going on here? Well, you should have been in already. But I think the surge that takes that out will be very dramatic and very quick, to where if you're not already in this beast, that'll occur so fast you probably won't participate. Similarly, I think the stock market will expose itself the other way, probably beginning, obviously, next quarter, for example. So that's where my focus is. I think the Bloomberg will tailcoat that to some extent, and I think gold will do quite well. I think gold could easily double, if not more, between now and the end of the year. Get up to 8,000. Why do I say that? It's an idiot thing. If you go back and look at the history of gold over the last 50 years, there have been a couple 8-fold moves on a logarithmic scale. If we have an 8-fold, we're going to 8,000. Now, I'm not arguing that's the ultimate end of it. I'm just arguing in this phase, the acceleration phase here.